Welcome to my Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. Today, we are looking at the Strait of Hormuz and what a prolonged disruption there could mean for oil prices, supply security, and China's broader energy strategy. Joining us today is Liao Na, Chief Consultant of Energy Policies.
Thank you. Glad to join the discussion.
When people talk about Hormuz disruption, the first reaction is usually to think about shipping risk or supply disruption. But this seems to be a much bigger story than that. How do you frame it?
It is definitely bigger than a shipping story. Hormuz matters because it sits at the intersection of route security, resource security, and currency security. So, this is not only about whether cargoes can pass through the strait, it is also about who controls key routes, who absorbs the added cost, and how energy trade fits into a broader strategic competition. That is why the market is not treating this as a one off disturbance. It is being priced as a geopolitical premium with longer term implications for supply chains.
So the more important question is not whether the strait is formally closed, but how much of it is still functioning in practical terms.
Exactly. What matters is the effective transit rate. Once that falls sharply, pricing logic changes. The market stops trading mainly on supply demand fundamentals and starts trading on risk, insurance, and confidence. Even without a full physical blockade, shipping can still be severely disrupted if insurance premiums surge and ship owners become reluctant to enter the area. That kind of commercial disruption can be just as powerful as a physical cutoff.
And from China's perspective, does that immediately create a crude shortage problem?
Not immediately. In the near term, the bigger issue is price risk rather than supply risk. There is a shipping lag, so the effect of any disruption in Middle East flows does not show up all at once. Existing inventories, including cargoes already in transit or stored near port, still provide a meaningful buffer. So the first shock is more about cost distortion and margin redistribution across the chain rather than an outright shortage of crude.
So, in practical terms, the first pressure point is not availability, but rising procurement costs and uneven margin pressure.
That is right, and the pressure will not be uniform. Refiners with heavier dependence on Middle Eastern medium and heavy crude are more directly exposed if disruption persists. Others have a bit more sourcing flexibility, but that does not mean they are comfortable. High crude costs are difficult to pass through when downstream demand is weak. So, even for players that can still secure barrels, margins can come under significant pressure.
And I assume that in some parts of the downstream chain, the strain can appear even earlier than in crude.
Yes, that is an important point. In some chemicals, inventories are lower and import dependence on the Middle East is higher, so the market can feel the pressure sooner. Crude may still look manageable for a period of time, but some downstream feedstocks are more sensitive to prolonged disruption. That is where the supply chain becomes more fragile.
Let us turn to prices. A lot of attention is on whether oil can stay above $100 a barrel for how long. What is the key variable there?
The key variable is still whether the strait can return to a more normal level of transit. Oil will not move back to a normal pricing range unless confidence in passage is restored, and that depends on several things at the same time: the political pressure created by inflation, the military sustainability of prolonged confrontation, and whether commercial shipping confidence can be rebuilt. If those conditions do not improve, the geopolitical premium can remain in place for much longer than many people expect.
So even if the market avoids the most extreme outcome, a lower but persistent premium can still stay embedded.
Exactly. The market does not need a total shutdown to keep prices elevated. A prolonged period of partial disruption combined with high insurance costs and recurring uncertainty is already enough to support a higher oil price range. That is why the question is not only whether prices spike, but whether they remain structurally firmer for an extended period.
How is China responding under that kind of environment?
The response works on several fronts. The first priority is to secure domestic supply. That means being cautious on product exports and keeping more barrels and products at home. The second step is to reduce unnecessary crude consumption pressure, so some refiners have already moved to cut operating rates as a precaution. The third is inventory. China has a relatively broad stock buffer, including both strategic and commercial inventories, so there is room to absorb short term disruptions without rushing into emergency measures. And then there is diversification. If one route becomes riskier, sourcing has to become more flexible, whether through pipelines or through more long haul imports from non Middle East suppliers.
What also stands out here is that The response is not only defensive, it also seems to reinforce a much broader structural shift.
Yes, that is where this becomes more than a short term supply story. Higher oil prices and heightened geopolitical risk are strengthening the case for a broader energy transition. When crude moves above a certain level, transition economics change. Things that were mainly policy supported start to gain market logic as well. Coal to chemicals becomes more competitive. Alternative fuels move closer to commercial viability. Electrification becomes more attractive. So the external shock ends up accelerating internal restructuring.
So the pressure is painful in the short term, but it also speeds up changes that were already underway.
That is exactly the point. In the short term, the economy faces imported inflation and cost pressure, but in the longer term, the shock pushes the system to move faster toward a more secure and more diversified structure. It supports the shift away from an efficiency first model toward a security first model. And once that shift becomes more deeply embedded, it affects not only fuel consumption, but also industrial distribution, investment priorities, and the relative competitiveness of different parts of the energy and chemical chain.
Does that also mean more pressure on weaker or less efficient production capacity?
Yes, sustained high crude prices expose cost disadvantages very quickly, especially when product demand is not strong enough to absorb those costs. That will likely accelerate consolidation. Efficient, better integrated players are in a stronger position, while weaker capacity comes under more pressure. At the same time, carbon constraints and green power requirements are becoming more important in determining which projects remain viable. So, this is not just a crude supply issue, it is also a filtering process for the next stage of industrial restructuring.
And geographically, does that also support a shift within China's industrial system?
It does. Energy intensive sectors are likely to face increasing pressure in regions where carbon costs and compliance burdens are rising. That creates more incentive to move capacity toward regions with better access to lower cost power and stronger renewable resources. So, geopolitical disruption in oil is feeding into a much broader reordering of energy, industry, and regional competitiveness.
Before we close, what are the main things the market should watch next?
There are two immediate watch points. The first is physical arrivals, especially once the impact of the shipping lag has fully passed through the value chain. That is when inventories will become a more meaningful test of supply resilience. The second is policy response, including whether there are changes in reserve management, fuel pricing, or other stabilizing measures. More broadly, the market should watch whether Hormuz disruption remains a temporary risk premium event or becomes the trigger for a more lasting shift in global sourcing patterns and China's own energy transition pace.
So the takeaway is that Hormuz interruption is not simply a transport disruption, it is a geopolitical pricing event, a supply chain stress test, and a catalyst for China's longer-term energy repositioning.
I think the key takeaway is that this is not only a short term disruption story, it is also prompting the market to think more carefully about supply security, policy direction, and long term competitiveness. For China's energy market in particular, those issues are becoming more closely connected than before.
And for those who want to follow these shifts in a more structured and forward-looking way, GL Consulting's China Policy Perspective monthly report offers regular, actionable updates on national and regional policy direction, energy transition priorities, and the evolving competitiveness landscape in China. Thank you for joining us today, Liao Na, and thank you to our listeners for tuning in. We look forward to having you with us again in the next episode.